In this episode, we speak with Trevor Clark, founder and managing partner of Twin Brook Capital Partners, TPG's middle market direct lending business. Founded in 2014, Twin Brook provides tailored, cash flow-based financing solutions to middle market private equity-backed companies across North America. Based in Chicago, Twin Brook has approximately 125 dedicated professionals and offers a flexible product suite supporting leveraged buyouts, recapitalizations, add-on acquisitions, growth capital, and other financing needs for companies typically generating between $3 million and $50 million in EBITDA. TPG Credit is part of TPG, a leading global alternative asset management firm with $286 billion in assets under management. Prior to founding Twin Brook, Trevor was a co-founder and CEO of Madison Capital Funding, a subsidiary of New York Life Investments, where he led the firm's middle market lending platform. Earlier in his career, he held underwriting and origination roles at Antares Capital, GE Capital, and Bank of America. TPG Twin Brook was recognized as a top private credit firm of 2025 by GrowthCap. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the managing partner of GrowthCap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
Trevor, great to see you. Thanks so much for taking the time.
Likewise. Thanks for having us here.
Where I'd like to kick off is this kind of combination between TPG and Angelo Gordon. And of course, Twin Brook predates that combination. And there's some history as how you got, I guess, involved or set up under AG. So maybe let's start with the original story and then we'll come up to present day.
Sure. Let's start with this because it's still a longer history. I've had 30 years in the direct lending space. And the first 7, when you go back for that length of time, includes kind of banks and non-banks, but took that kind of early experience and then ended up writing a business plan back in 2001. And as we talk through what it is that we do and how we fit in, that was really focused on kind of creating a niche market within, we'll talk about this lower middle market part of the marketplace. Really back then you couldn't form capital the same way you can today. And so ended up really getting involved with a big insurance company and founding Madison Capital Funding with a group of individuals back in 2001. It really was there until late 2013 and the world had started to change. And as you point out, the ability to form capital had changed. So groups like Angelo Gordon could be good, reliable partners. And we brought senior members of our team over to establish a new direct lending business in the same space that we had been operating since 2001, but really with the idea that what Angelo Gordon brought was a level of flexibility and forward thinking that we thought would be a really good fit for us and our team as we looked to kind of execute on our strategy of growth.
And what do you think it was that enabled you to stay relevant to your target market? Because presumably there was other competitors coming into this space and you probably had to think more carefully about your offering to the market.
For sure. When you think about what it is that we do as a lender, you're bringing a commodity to market. So the ability to be a reliable counterparty, someone who can be counted on to execute was really critical. Part of the reason why we selected Angelo Gordon versus other groups that had approached us was you had a asset manager in Angelo Gordon that had been around for 20 plus years, had not been coming and going, getting in and out of businesses, had a great track record of not only building a culture, but these strong, reliable teams. We found that to be something that was important because, to exactly your point, having that type of parent support meant that we could be a kind of a value-added partner to our counterparties, specifically with our lending being focused on private equity-backed companies.
Mm-hmm. And have you always been focused on private equity-backed companies? Like even in those early days, when you found that there was a gap in the market, it was indeed partnering with these PE firms?
So prior to 2001, no, we did both sponsored and non-sponsored work. Part of the thesis when we wrote that business plan back in 2001 was focused on The world of lending, lots of different ways to do it and lots of ways to be successful. Part of what we wanted was something that had a little bit more durability. So we were looking for the part of the market that provided a very attractive return, but one that was also durable. For us, that meant there was a value proposition in the lower middle market. It's a less efficient market. It's harder to find the very best companies, so it doesn't attract as much lending competition. But if you're trying to get that premium on the return side, the average small company had more volatility. So we wanted to bring more stability to that return. And that's where we thought the private equity ownership was an important differentiator.
By now, you probably have your longstanding relationships with PE firms. Curious what you look for. I mean, it's somewhat obvious to identify the longstanding private equity firms that have been out there and growing over time. But maybe what did you look for in those early days and what do you look for today?
Again, it's a good question because you also have to balance this. You realize as a lender, when you get shown a transaction from a private equity group, we don't have the same metric. The private equity group can do 20 deals and be right 14 out of 20 and still create a return. Lender doesn't have that same dynamic. So number one, you had to have breadth in regards to the private equity relationships. But as you point out, what we wanted to see were some kind of specific characteristics in these private equity groups. Average things like, oh, okay, how big of a fund do you have? What's your history of forming capital? And then things that were a little bit more specific. We wanted to know every private equity group speaks about having operational expertise. Do you have that? Have you proven that over time? How do you view your lender relationships? Do you view your lenders as a commodity, or are they really a value-added partner that you look at working alongside as you create value and grow these companies? That was important to us. And then the history. Does this private equity group work with 30 different lenders, or do they really try to focus their time and energy with a handful? And we try to kind of look into that and reflect that. To your point, we've been doing this for so long now. I can tell you for the most part, we've been really focused on not only building those relationships, but expanding those relationships.
Mm-hmm.
As a lower middle market lender, you won't be surprised to hear there are definitely groups we were working with 10, 15, 20 years ago who've grown and gotten to the size where they don't focus in the lower middle market. So we don't work with those groups anymore. But it's equally nice to see oftentimes when those groups do expand and grow into another part of the market, you'll see some of their partners spin off, form new lower middle market firms. So we've seen at least 20% of our new relationships being partners that we worked with at other firms.
I'm curious if CEOs and management teams ever get involved in the decision making of who the lender should be.
Boy, it's another great question. And so the answer is for sure, they have a voice in it. The private equity group, as the owner, is making the final decision. But when you think about we're coming in to these management presentations, they're seeing the questions we ask. We get asked questions by this senior leadership team at these companies because they want to know, are you going to be a supporter of their growth strategy outside of just the private equity group? Because remember, we're bringing a significant amount of capital as well.
Mm-hmm.
And then the next thing they want to understand is how knowledgeable are we on this space? This is where the fact that we've been doing this so long helps because we can show up and say, we know your industry, we know your competitors, we can be that reliable source of capital.
And so internally, are you structured such that you have a certain number of managing directors focused on sector A, and then you have kind of, divided up into sectors so that you can appropriately evaluate and maintain these relationships with companies in those sectors?
If you look across this, we're broken up in origination focus and underwriting focus. We have a capital markets team, we work out some different functional areas. To your point, we do have specific sector expertise. The largest one for us is within healthcare. Just under a third of what we do, kind of more broadly termed within healthcare. So we have a group that's specifically focused origination and underwriting on that area. But then you move into kind of our non-healthcare sectors where you have specialty chemicals, you have aerospace, you have other kind of industry verticals. We'll have individual originators and underwriters who are more focused on that space. So when a new transaction comes in, yes, the sponsor relationship matters, but also that industry expertise is brought to bear.
How do you differentiate? Because we alluded to some of these aspects, but let's take it from the CEO management team and, I guess PE sponsor standpoint. How do you differentiate in that audience you're offering versus your competitors?
The most obvious one from that perspective is scale. We're more than 2 times larger than the next largest lower middle market group, just in terms of assets under management and the amount of the marketplace we look at. That's really a function of the length of time we've been doing this. And there are lots of good groups in the lower as well as core and upper middle markets. But we're unique in regards to, if you think about it, a group that's been focused solely on the lower middle market now for 25 years in its two different parental ownerships. That's pretty unique. Most lenders who get to scale in the lower middle market tend to focus up market because it's easier to deploy capital. We haven't followed that. So that's a pretty big differentiator. Then extend that. Being in a target market for this long, showing that you'll be that good, reliable partner today, but also in the future is important. The team's important. The fact that if you look at the senior members of the team, having worked together 15 or 20 years, doing this exact same type of work, that also gives you a level of comfort that, yes, I've got a relationship with the organization, but I also have a relationship with these people, and I know they're going to be around to support me and understand how we're going to interact together going forward.
You alluded to some of the differences in investing in the lower middle market versus the upper middle market. And so from an LP's perspective, when they're looking at how they're diversifying their portfolio and maybe what TPG, Twin Brook in particular is bringing to the table, there's some favorable, characteristics in this end of the market.
Sure. So let's do this. We have conversations with prospective and current LPs, obviously, all the time. I'll highlight things that they seem to be the most focused on right now. One, there is a lower middle market premium. If you're willing to do the work, you're going to look at a lot more small companies to find the very best ones than if you look at larger companies. So that premium, if you have the right team and experience to be able to hold on to that through a cycle, is something that I think the marketplace and LPs really do appreciate. If I'm going to be investing in a space, why not maximize the return on those dollars within that space? The other piece that's been getting more and more focus is overlap. Standard & Poor's started publishing, I want to say 7 years ago, this heat map that showed the publicly available information of these different direct lending investors' books, how much overlap by name. And we consistently have one of the lowest levels of overlap between different groups. So for an investor who looks and says, okay, I don't want to put all of my eggs in one basket, I want to have a couple different managers I work with. Well, don't choose two that have 20% of their book being identical. You're not achieving what you wanted. And then the last piece we seem to see people really focused on, you have this track record. The experience definitely matters. Most LPs now get the benefit of being able to choose a direct lender who has an experienced track record. Part of what people are also getting more focused on is how indicative will your track record be of my investment experience with you? Meaning, if I'm underwriting what you did for the last 5 or 10 years, how much did that change? Were you a upper middle market, top of the cap stack lender 10 years ago, and now you kind of do unitranche and you do big companies, small companies, it changes a lot? Or, okay, you have been that nice, consistent, I can look at that track record, and that does provide me a good indication of what I'm underwriting is what I'm going to get.
To the overlap point, you have less overlap than others. Is that because you have more maybe unique relationships with certain select PE sponsors?
I'd put it into two camps. One is because we're lower middle market focused, but very, very scaled, 60% of the credit facilities we're closing on, we're the sole lender. So
Right.
that in and of itself is going to create a kind of a unique dynamic. The other piece, yes, we have some unique sponsor relationships. I think it's the breadth of also what we cover. We have over 900 different private equity relationships that we source from. In the last 5 years alone, I think we've closed transactions with over 135. So I think that breadth also allows us to have some unique makeup of our market position and portfolio versus other groups.
And when you think about growth in the years ahead, both in the next few years and even longer term beyond that, where do you see the growth coming from?
I think it's multiple areas again. I think the middle market in general, and you've seen this over time, as merger and acquisition activity has ebbed and flowed, you have seen kind of the private credit space take more from the kind of the public credit space in general, and that's more upper versus lower middle market. But in general, what you've also seen is flows from historical commercial banks to non-banks continue to grow. I don't think that's going to change. The big question mark for us is, what is the pace of growth going forward? You've been in this period of time post-pandemic where you've seen certain periods of time where it's been very, very active, The last 18 months, you've kind of seen some modulation in terms of overall merger and acquisition activity. And again, what I point people to when you kind of think about that, this is where manager selection really matters. Having someone that has a direct origination force, meaning I have to call other lenders a source. I'm creating my deal flow myself, having a big book of business. We have over 300 unique borrowers. That creates add-on lending activity as well. That's important as well. And then finally, the ability to source from a wide enough funnel, meaning, are you sourcing from just 10 different groups, 10 different private equity groups, if you're private equity focused, or in our case, casting a very wide net. When you kind of see those metrics, that allows you to feel comfortable that regardless of market conditions, you have the ability to pivot your business in a way that you can consistently deploy the capital. One last piece to add, because I think this is also important. Deployment, we keep talking about. The other side of that coin, capital formation. And the reason why we also focus on that topic is if you saw a group like us and you look at the dollars we've been deploying, and it's been kind of steadily growing, but probably growing depending on year-over-year basis, growing probably within kind of the 10 to 15, maybe in a 20% difference year over year. If you saw my capital formation be at a much different pace than that, meaning if one year I was raising a few billion and the next year you saw, you raised $7 billion of new investable capital, I think it also needs to start to come in and look at, okay, does this put additional pressure on you to have to invest in a way that you hadn't historically done? Hold sizes changes, selectivity changes, how aggressively you need to price deals. So I think those two things have to be kind of seen in being in tandem with each other.
Being at the helm of Twin Brook, what do you most focus on? Your mental energy operating this organization, what are you most focused on?
I'd love to tell you it's one thing because it definitely is a moving target depending on what's taking place in the market. If you would have asked me that 5 years ago, I would have been much more focused on capital formation. We were taking market share. We wanted to make sure our capital formation kept up with our ability to deploy capital. And with the combination with TPG, for the most part, that's been solved, which is great. Now we sit back and look at some of the stresses that you've seen introduced into lenders' experience over these last 5 years. You look at the pandemic and the shelter-in-place order, and you came out of that, and then you saw things like wage growth, ability to find appropriate levels of staffing, high inflation, low interest rates, high interest rates. Now you introduce tariffs. So I probably spend as much time looking at what does that mean to new transaction activity as well as existing portfolio company performance. That's something that we probably spend more time on. And then the last piece is just team. We're over 130 people today, and you want to make sure people feel engaged and motivated and excited to do what we do. And again, we've been very, very blessed to have a really experienced team, but one that's experienced very little turnover as well.
Last two questions. One is, can you tell us about a person who has had a profound influence on you?
It's a great question. And I'd, again, love to have it be just one person. I would sit back and probably point to my parents, but it extends beyond just my parents because I grew up in a family where there were a large number of entrepreneurs. So I got experienced early on. My first job out of college was working for an uncle who was in the Seattle coffee scene very early days and showed me this whole idea and this path towards not just getting into, because prior to those experiences, my expectation was you get into a corporate environment, you do really well and you move up versus creating your own opportunity. And so having that experience with my uncle early days to kind of see this idea of if you don't see the job you want, you can go out and create it and create an organization around you, surround yourself with really good people. And so getting that introduction early on of feeling that level of confidence in yourself to be able to do that, but also trust that if you're willing to put in the time and energy and have the right type of team around you, you can kind of create those opportunities. That was something that without having that family experience, I probably wasn't getting that type of experience from my school.
Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
Absolutely. I was fortunate almost a decade ago to get introduced to a phenomenal young woman who had started a new charitable organization. Quick story, Courtney Johnson formed an organization called the Culinary Cares. And the focus of that organization was really bringing food-focused support to people going through cancer treatment. She had lost her father to cancer when she was in high school, and at 23 created this new organization. And if you think about it, for someone who's going through something like chemotherapy, obviously dealing not only with the impact it has on your health, but the fact of the matter is when you're going through something like that, the type of food you could eat, the type of nutrition you need to be getting, very different than for the kind of the regular way person. You're already dealing with all of that impacts, the stress on your system. To have to be focused on finding the right type of food is hard. And so what Courtney was able to do was really bring a network, and that started in Chicago. So that's how we got introduced. And she worked with local restaurants and bringing restaurant quality food delivered to people going through kind of those cancer treatments. And she's delivering tens of thousands of meals to 12 different cities.
Amazing. Well, Trevor, I want to thank you again for taking the time. It's been a great conversation.
Likewise, appreciate the time today. Thanks so much.